Advisors Asset Management offers a suite of innovative ETFs to help investors meet their income and capital appreciation goals. Visit aamlive.com/ETF for more information.
Welcome to the latest episode of Exchange Traded Fridays, a weekly podcast offering an inside look at all things ETFs. I'm Jeff Benjamin, Wealth Management Editor at ETF.com, and I'm joined this week by colleagues Sumeet Roy, Senior ETF Analyst, Ron Day, Managing Editor, and Kent Tooney, Research Lead.
Hey guys.
All right. This week we're talking about BlackRock's plans for a suite of bond laddering ETFs that will automate the investing process. We're also going to look at the latest inflation data and how that might impact markets. And we're going to wrap up with some exciting election banter, since this is our latest podcast before the election on Tuesday that will hopefully determine who our next president will be. So with that, we're going to jump right into these I-bond ETF ladders that BlackRock announced this week. This is a story I wrote about. BlackRock has had I-bonds ETFs since 2010. They're across, I think, treasuries, tips, corporate bonds, high yield bonds, and I think munis. And they've got over $32 billion in there. It's very popular. These were designed and are designed specifically for bond laddering. It's like buying an individual bond and holding it to maturity, except it's more than one bond in each ETF, but they do mature on a regular cycle. So advisors and investors like to buy these things and then build out ladders that as they mature, you take the matured rung of the ladder and you might reinvest it by another rung. You might allocate that money elsewhere into equities or something, or you might take the cash if you're in retirement and use that to finance some of your living expenses. Anyway, they're really popular. BlackRock knows they're popular. BlackRock's not the only one that has ETFs designed for these laddering purposes. But at some point between now and the end of the year, BlackRock is going to be the only firm to have ETFs, a suite of ETFs that are designed to do the laddering for you. As these things roll off, a financial advisor or an investor has to make a decision with what to do with that. The way the new suite from BlackRock will operate is you can just own these continuously. You can take money out at any time. You don't have decisions to make every year or every quarter or something like that, or every couple of years. It seems like a good idea. It seems interesting. It seems like a solution to a little bit of a problem. I was talking to the folks at BlackRock, and they said that they're seeing financial advisors that are actually outsourcing the laddering process. I mean, which I think is kind of interesting because it's not that difficult, but it is something that you have to do to keep these ladders extended. And anyway, so they have a suite of 4 different bond ladder ETFs, focus on treasury bonds, tips, corporate bonds, and high yield bonds. And they're going to all invest in the existing I-bond ETFs. And there's not going to be an extra fee on, even though these are technically funds of funds, there's not going to be an extra fee on top. You're just still paying the fees that you would pay for the I-bond ETFs. It sounds like a good idea. It sounds like to me another one of those things that could maybe make the financial advisor a little less relevant. I asked BlackRock about that, and I mean, they said, well, the financial advisor will have time to do other things, prospect for clients or whatever. Yeah, it's innovation. It's progress. It's going to happen. But I don't know. What do you guys think about this? It seems like now that BlackRock's done it, we're going to probably see it elsewhere. Ken, what do you think? What are your thoughts on bond laddering in general?
Well, in general, bond laddering can be a good idea, but I like to look at what environment. The best environment, in my opinion, and I think it's not just an opinion, it's just kind of fact, would be rising interest rates. Or if you expect rising interest rates, or if someone wanted to hedge against the possibility of rising interest rates. Mm-hmm. Because if you're bond laddering, I mean, by definition, you're renewing those maturing bond issues into newer bonds. Well, if interest rates are falling, why would you want to buy newer bonds at lower rates? Why don't you just buy an individual bond now and lock in a high yield for as long as you can? On that note, I won't trash these new products, but I do like their regular I bonds where you could buy just that single maturity.
Mm-hmm.
But on that note, if I'm an issuer, I'm going to provide things that I think investors or advisors want or need. And there clearly is a need, at least according to BlackRock, for this type of product for advisors.
Yeah, I think Kent makes a good point. If you have conviction and a strong view on where interest rates are going, then obviously, for example, if you think interest rates are going to go down, you could lock in the yields in longer term bonds now. Why wait for yields to go down? On the other hand, if you think yields are going to go up, you want to stay in those ultra short term bond ETFs, the money market funds. You don't want to take any interest rate risk. So I think bond laddering is more like when you don't want to make an interest rate call or you don't have any idea where interest rates are going to go. You kind of hedge your bets by buying many different maturities. So if you have a strong view on interest rates, this is probably not for you, but this is more for people who don't have a strong view or don't want to make a strong call when it comes to interest rates.
Yeah, well, just to be clear, these are the duration on these ETF laddering or these laddering ETFs is between 1 and 5 years. So they're definitely staying on the short end, even though the I bonds ETFs they extend out to 2034. So there's a lot more that BlackRock could do as rates move, but right now they're staying on that short end. And I mean, they're basically the way laddering works is you can have a short term or short duration bond or bond ETF, but if it is one of these defined maturity ETFs, it is going to mature and something has to be done with it. So this is just I don't know. I'm kind of a fan of laddering, but the more I learn about laddering, the more I run this past fixed income experts out there, they're like, it's really kind of a feel good thing. You're really not getting anything extra than you would if you just bought like a diversified bond fund or something like that. But this seems like one of the things that is probably going to, if you're already in I bond ETFs for laddering purposes, why not go here? It doesn't cost you anything else, and you basically eliminate all the maintenance on these portfolios.
Do you know, Jeff, how much money is in the I bond ETFs right now? Are they pretty popular?
over 32 billion.
Oh wow, that's a lot.
And keep in mind, it's a rolling number, or it's not a rolling number, but it can be a fluctuating number because these are not the kind of things you can just set in. Once they mature, they roll into another one or they liquidate or something. It's not like a bond ETF where you can just put your money in there and forget about it forever.
Hey, Jeff, the other day when you were first mentioning this, you did seem to kind of cast a little bit of, kind of a, what do you say, like a hairy eyeball at it? Like, is this really the kind of thing that, people really need? And as somebody, full confession here, I did not know what laddering was. I didn't really know what tips were, when I started here. And, but now as someone who is approaching a kind of a retirement / semi-retirement, I go, hey, now, maybe this is something I want to be looking at, when I just to kind of generate, steady income. But maybe it's just maybe a little too simplified or?
Well, this is the way I look at laddering. This is the way I've always looked at laddering. You basically extend out however many years you want. You could go out to, let's say 2034, for example. You buy one that matures every year or every other year or, the next until 2034. As that top rung on your ladder matures, you take the money and you either buy another, depending on where you see the market or what you want to do with your money, you buy another rung, or you maybe say it's a good time to get into equities. They're low right now. I'm going to use it for that. Or you're in retirement. You might use that money. But what it provides, usually retired people, is a predictable income stream because when that bond matures, you're going to get, exactly what you're going to get. So that's the appeal there. This is a little bit different because it is a perpetual rolling maturity. These things will the BlackRock will roll these things off as they mature. So it basically becomes something just like a bond fund that you can take money out of at any time. You can take money out of, you can, these things don't have lockups or anything. Even the I bonds ETFs, but it's a little bit different. I think to me it seems like it has the name of a ladder, but it's just, to me, feels more like a bond ETF, even though it is doing rolling ladders inside of it, and it does give you that that known outcome for each of these bond ladders, because they mature just like bonds. They mature just like individual bonds. You hold them to maturity, and you get what you get what you're supposed to get based on the yield. Anyway.
I'll add one quick point. I like the fact, I say this frequently on this podcast, but I like how it just shows yet again the innovation of ETFs and what you can do, carve out almost any type of plan. And I like how BlackRock's taking a lead on that. So yeah, it speaks to the innovation for sure.
It does. And like I said, I wouldn't be surprised to see more issuers follow this lead, as long as they've got the underlying defined maturity ETFs to build those ladders, or build those laddering ETFs. Okay, on that, since Kent gave us his thoughts on bond laddering, and it sounds like he's very enthusiastic about this latest inflation data, let's shift over to an update on that, where we are right now. Here it is. Just so you know, we're recording this on Halloween, October 31st, and Kent, what's your thoughts on the PCE out there?
All right, correct. Yeah, PCE came out Thursday morning. And so, I wouldn't say I'm enthusiastic about it, or just looking at what ETF investors think. First of all, the PCE came in pretty much as expected. Year over year, the core PCE, which excludes food and energy, increased 2.7%, just a little bit above, a hair above the 2.6% consensus expectation. So that's not really a big market mover there. Excluding food and energy, or what we call the headline PCE price index, was up 0.2% month over month, and 0.2% expected. So that's annualized 2.4% inflation, which is not down to the 2.0 that where the Fed wants to see it, or where they say they want to see it. But I would say this was maybe a little bit of a relief that things weren't worse than expected. Or actually, I should say a lot of fixed income investors have been almost trained to expect the worst over the last month or so, because of the other economic data reports have been somewhat inflationary. So everyone's just kind of got the inflation jitters right now. And so looking at what the market's doing, I mean, TLT is pretty much flat as we speak. And again, that's Thursday, midday after the PCE report. So investors are not exactly turned off by it. Some of the longer maturity ETFs, like up to 30-year average duration, or close to that, are slightly positive. Now, some of the alternative fixed income alternative ETFs, like say utilities, the XLU ETF was up 1.4%. And I believe we mentioned this recently on this podcast. Utilities is the number one sector of the entire year. And that's a part of it there, is that it's an alternative to fixed income, an alternative to the some of the risk concerns that investors have with bonds, especially like TLT, and it's a defensive move. So that's in a nutshell, what I'm seeing and what ETF investors are seeing after this inflation report.
Also, Ken, next week is the Fed meeting, if I'm not mistaken, and we could see a rate cut. Do you think this inflation number changes anything with regard to what the Fed might do?
Well, I would just go in alignment with what the futures market is saying. I mean, I think I didn't check just now, but I think it was close to 99% expectation for a 25 basis point rate cut. Just a couple of months ago, the market was expecting pretty much 250, maybe 50 basis point rate cuts through the rest of the year, which is the next couple of meetings. But yeah, I maybe that's why bond prices and yields aren't really moving much today, because it's like, okay, we're good to go on the 25 basis point rate cut. And maybe the concern was if the inflation numbers were worse than expected, inflationary, maybe that 25 basis point rate cut would be taken off the table. So I would say the market's still saying, okay, 25 basis points. And we're going to keep on going and hope for better inflation reports coming in the next month.
CME tool is saying 93% odds for 25 basis point cut.
Okay.
Yeah.
Yeah, and that's what maybe slightly lower than what it was a couple of days ago, but still, I mean, over 90%. I mean, I would say the market's pretty much expecting to stick right there.
So we're talking 25 next week, and then did you say 50? Is there another meeting this year after next week?
Yes. Now Juan's in that tool right now. He might be able to see what the market's expecting for that.
I'm looking right now. I'm not finding it. 18th of December is looking 74% for the rates to go to 425 to 450. So
yeah. So it looks like another 25. 25 yeah.
points. Right.
And of course, we're recording this on Thursday, but we do have a jobs report coming out on Friday when this podcast is going to be posting. And that could obviously shift the odds a little bit this way, that way. Expectations are that there were 105,000 jobs created in the month of October, down from 254,000 in September. That number, though, I think is going to be impacted by the hurricanes that we saw. So it's going to be hard to disentangle what the actual job market looks like when you exclude the impact of the hurricane. But we'll see, is this going to shift the odds? I doubt it's really going to, change the course of the Fed. 25 is likely what we're going to get it unless we see a massive surprise on that jobs number. But, we're talking about fixed income. And, I'm looking at the flows for, ETFs this year when it comes to fixed income, and it's just all across the board. You have people putting money into things like AGG, $18 billion of inflows this year, BND. Those two are obviously the two biggest bond ETFs on the market. And, investors who want broad exposure to investment grade bonds, those are great options there. But below that is TLT, and that's a completely different animal, focusing on just one segment of the investment grade bond market, the very long end 20+ year treasuries. That's seen big inflows as well, $12-13 billion so far this year. One that really stands out to me, though, is JAAA. This is a fixed income ETF we don't talk about a whole lot, but it's one of the top 5 asset gatherers this year in terms of fixed income, $8.5 billion of inflows. And this is a AAA rated CLO ETF. And it's currently yielding around 6.5%, which is well above what you can get, obviously, in treasuries. So a lot of people, like this ETF. It's a floating rate ETF. So as interest rates go up or go down, the yields on this ETF adjust to that as well. So you're not really locked into any yield. So it's interesting. A lot across the board. We're also seeing inflows into SGov, which is the ultra short-term bond ETF. So you have everything from TLT all the way on the far end to SGov on the short end. You have broad market ETFs like AGG, and then you have a CLO ETF like JAAA, all seeing huge inflows this year.
Yeah, interesting to see where money moves when the Fed starts to, I guess, rattle its cages there. Everybody who knows me knows how I feel about TLT. I just will never understand why people are pouring money into that thing at this point.
Well, hey, Jeff, I'll turn the spotlight on you and give you some props for reporting on that Folio Beyond Alternative, the RISR, Riser ETF. I was just looking at our handy dandy ETF Pulse tool, my favorite new tool on our website. That fund is the top performing fixed income ETF over the last month. And the fact, let's see, it's what it invests in is, according to our website again.
Yeah, interest-only mortgage-backed securities.
There you go, man. You wrote on
Yeah.
it, so you know all about it. But yeah, I mean, it's up over, it's at 4.6% over last month, which pretty much just crushes every other ETF behind it for the last month.
That is an interesting ETF because you would think it would be something that is designed for a rising rate environment, but it really is because it invests in the interest only portion of mortgage-backed securities. There seems to be a lot of room to run there because we're still a ways from rates coming down to anything even in the 5% range, I think. I don't know. I haven't refinanced in a while. But anyway, it's a good time to shift over to the election. I think anybody that has a television, radio, or a mailbox is probably already exhausted by the politics and the noise and the campaigning and everything else. But as
everybody's tired except the psychotherapist, Jeff.
Right, yeah, that's
There's,
true.
I mean, there's no ETF called Shrink or anything like that, but
not yet. There isn't. But this is I mean, volumes have been written and spoken about the impact of presidential elections and presidents on the financial markets. But we're going to give it one more punch here. I'd like, Ron, if you can kind of give us a little bit of your thoughts on this. You're a veteran journalist. How these, what people can expect. I mean, somebody has to win. Unfortunately, it's either going to be Trump or Harris.
Well, I just want to throw out first. I mean, there's a lot of things over the past few days. I mean, PCE seems to me, it just kind of mixes things up, because the picture still seems murky going into the last few days. There's still these folks in the center who are going to decide this, and prices going down it's going to help. You would assume it's going to help Harris, but I don't know. It's so hard to know. I did get a kick looking at the front page of the Wall Street Journal today, and Greg Ip's column saying the next president inherits a remarkable economy.
Mm-hmm.
So, I mean, it's like, well, do we want to move? Or I don't mean do we want to change things, but the question is, are people generally going to be saying they're satisfied? There was another, and then right below that was another piece saying, a Harris victory represents a fourth Obama term. Now, that was the WSJ's editorial, so clearly they meant that in negative terms. But I'm not too sure everybody will read it that way. I just think, economically speaking, it's, it's kind of, it seems like things are not, since Obama, I mean, we've been doing okay. I mean, the economy has been, and markets have just been, I mean, they've been good, right? I mean,
That's
go ahead.
Great point, Ron. I mean, we've been hearing this for the last few years, right? The economic data has been great. Unemployment has been sitting near 50-year lows, yet you look at some of the consumer sentiment surveys and they've been pretty negative. People have been feeling bad about the future, bad about the economy. I think people have been using the term the vibe session to describe this phenomenon where, the hard economic data has been great, but people haven't been feeling great about the economy. So it's going to be interesting to see how that manifests in this election. But yeah, I mean, if you look at the markets, you look at ETFs over the past 2-3 weeks, you've been seeing a lot of the Trump trades starting to rally. And I think that's a reflection of, people thinking Trump maybe has a better chance of winning the election than Harris. You look at things like the 30-year bond, for example, the yield on that has been rising. And the idea is that if Trump comes into power and he has Congress on his side, he could cut taxes, and that's going to, create larger deficits. And that's why we're seeing interest rates rise on the 30-year. We've also been seeing, financial ETFs go up because maybe Trump is going to deregulate. And likewise, we've seen solar ETFs go down because obviously Republicans favor fossil fuels over alternative energy and things like that. But I think just over the past few days, maybe the vibe has shifted a little bit, and now people are thinking, okay, maybe Trump isn't a shoo-in, it's more of a toss-up. So it'll be interesting to see how the markets move over the next, 1 or 2 days before the election, and then obviously what happens after the election. Are we going to see big moves?
While it's not a direct correlation with ETFs, I mean, Trump's Truth Social stock has been very volatile. I mean, it was up 20% the prior week, and then it was falling so fast today or Thursday that the trading had to be halted. I mean, so I would agree with Samit is that it's been shifting back and forth, and right now it's kind of a toss up. And I'll say my bottom line is that no investor should move their investments around just because what they think the stock market is going to do. And I think Jeff might agree as far as not just personally, but with the advisors he's been interviewing. Might say the same thing. Don't shift everything around based on who you think is going to win, or even after the election. Just keep doing what you're doing and stay steady.
Yeah, I think the best example of that was when Trump was elected in 2016, and there was a whole contingent of people that thought the world was going to fall off a cliff and sat out of the market for the better part of 3 or 4 years and suffered tremendously, I think, by the rally that the market saw. I mean, don't put so much stock into what these people say they can do and then what they will do. It's other things that move markets.
Yeah, absolutely. And the most likely outcome is, I think, gridlock unless one party sweeps all Congress and the presidency. And if it is gridlock, we're unlikely to see big changes. The one area we could see big changes, even with gridlock, is the Trump tariffs. If Trump wins and we have Democrats controlling the House, let's say, he could still raise tariffs and we could still have another trade war. As he's promised, he's going to be, I think, putting 10 or 20% tariffs across the board and 60% tariffs on China. So that'll be interesting to see as well if he wins the election.
These things also it depends upon what kind of Congress we have.
Yeah. But my point is the tariffs, you actually don't need congressional approval. You could
all right, yeah,
do that unilaterally. So yeah, that's one area where a split Congress and presidency, won't matter. The president can have an impact there. But yeah, we'll see the election in a couple of days. Very exciting stuff. Maybe it'll impact markets, maybe it won't. But I echo what Jeff, you're saying. Do not change your long-term investment plan based on who you think is going to win or who ends up winning. That is a recipe for disaster. But I think that's a great place to wrap it up. Thanks to all our listeners for tuning in to Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or you want to share your thoughts, join the conversation with us on Twitter at ETFCOM. That's ETFCOM. Catch you next week.